So yes, global equities have done very well in recent years and are at record highs. But the important thing to note is that valuations are not at record highs because companies grow, profits grow, the economy grows, and therefore equity valuations are not extreme if you look on a global basis especially. And one also has to consider competing returns from other asset classes. And at the moment, cash rates are close to zero, bond yields are very low, and therefore against that mix, equities still look reasonably attractive in our view, and therefore we do think that equities can continue to outperform in the years to come. Generally, we have to recognise that bond yields are low and cash rates are low, and they're expected to stay quite low for the time being, even if interest rates start to rise gradually in the UK and the US in particular. We therefore think that from the starting point yields that fixed income returns are going to be lower than they have been historically. So fixed income returns are quite low relative to history. If we look to equities, we think valuations are around about long-term averages currently, at least on a global basis, and therefore we think global equity returns should be in line with historic long-run averages going forwards, which should mean that equities outperform fixed income over the years to come. So at the moment, in terms of our multi-asset funds and the asset management funds, we are overweight equities versus the benchmarks we have for those funds. We are underweight developed market government bonds and investment grade bonds because we don't see much return potential there because we expect yields to rise over time, which is negative for capital returns over that period. We see better opportunities in fixed income markets in terms of high yield, and also selective opportunities in emerging markets, specifically India and Mexico currently. From a currency point of view, our preferred major currency is the US dollar, followed by sterling, and we expect the euro and the yen to be the weaker two currencies of the four majors. We believe that what investors should really care about in the long run is to grow their wealth in real terms. That means after inflation. We therefore think that by changing the benchmark on the Replica Asset Management Funds to a CPI plus benchmark will align our clients' needs with the target return for these funds. Historically, the asset management funds have delivered a return well in excess of CPI plus 3%. And therefore we think on a rolling 3-year basis, CPI plus 3 will provide good returns for our clients going forwards if we can deliver to that benchmark.